Palantir and Tesla stock are going through a little bit of an interesting time. So this is since basically Christmas Eve here. So since Christmas Eve, Tesla stock's down about 13%. Palantir's down around 16% since Christmas Eve. So I want to talk about those two stocks at the top of this video, why those ones are struggling here recently. So kind of, because I know some people, especially if they're newer, they like to buy some of these sorts of stocks, right? And then they go down, 10, 15% all of a sudden in a pretty short amount of time. They're like, what the heck's going on here? So I want to talk about that at the top of this video and kind of explain what's actually going on with those two stocks, okay? Then I want to react to some videos up here. Josh Brown, dividend warning. He's actually talking about dividend investing there and a warning for everybody that owns dividend stocks. Then we're going to react to this one from a few hours ago. Dan Ives talking about NVIDIA's growth could be very underestimated. The bull market is still intact, but these factors could hinder it. Paul Hickey says, so I'm looking forward to reacting to that one. Adam Pitapaka talks about the areas you want to be invested in 2025. Looking forward to reacting to that one. Then we're going to react to a couple Fubo videos up here. This one obviously on the Fubo deal. And then additionally, David Gandler went on CNBC late last night and spoke about the deal as well. So not sure how many Fubo shareholders have gotten to see this video, but I wanted to react to this one because I thought it was very important. And as far as Fubo stock here today, looks like it's around 555. So yeah, I mean, obviously if you guys watched my main channel video last night on financial education, right, you know my full in-depth thoughts about Fubo and kind of everything going on there, but looking forward to reacting to those. By the way, appreciate everybody joining me as always. Thanks so much for being here, folks. All I need from you is one thing only. You know what it is. Smash that like button. That's all I need for the value of today's video, okay? If you want to be subscribed here, you can certainly subscribe. We're about to hit 70,000 subscribers here in the reaction channel very shortly, so appreciate y'all for being here. New all-time high. Additionally, if you're looking to apply to join my private stock group, my private wealth group, get access to 1000xstocks.com, all that stuff, pin comment down there, click on that, fill out a form. We'll see if we can get you access to all that and make you a much better investor. Maybe get you access to that later on this week or maybe this weekend, okay? Alrighty, guys. So what's going on here with Palantir and what's going on here with Tesla? Well, there's a very specific phenomenon going on with these stocks that you have to understand, okay? The first thing you got to understand is, obviously, since Christmas Eve, these stocks have gone down considerably. But if you back it up on a year basis, right, they've done tremendous. Palantir's up, even after this drop recently, Palantir's still up 300+%. Tesla stock is still up, 62% or so in the past year, right? So these stocks have done very well. Now, stocks like that are what you call momentum stocks. So the momentum stock is a stock that essentially has momentum. Think of it as a freight train. Once it gets going, right, it's tough to stop it. But once you get that baby stopped, it's not going anywhere until it gets that momentum back going. And so that's Palantir, that's Tesla. And the momentum has kind of stopped in regards to stock prices. And the reason being is the news cycle has slowed down significantly on those. You're not getting any big news on Palantir in the short term here. You're not getting any big news in the short term on Tesla. The only news we kind of have had recently around Tesla could be seen as a negative in regards to delivery and production numbers. So, that definitely hinders those type of stocks when the momentum kind of dies down a bit, right? And this is an important other part to remember here is both these stocks traded obviously very, very rich valuations. Tesla trades at 126 forward P. Palantir trades at 150 forward P. Now, assuming Palantir and Tesla both beat analyst expectations, maybe those are a little lower than where they're at. Maybe it's like 130 forward P for Palantir, 125. Maybe for Tesla, it's like 120 or 110. Still, I mean, it's still very high based upon any normal stocks in the stock market that are profitable companies. So, that's an important thing to understand. Now, I also kind of I posted this, about a half hour ago or so on X, on my X page. I said, Palantir's dropped about 16% since Christmas Eve. Are you buying, selling, or holding? Any year-end price targets for 2025? Yeah, I posted that about 30 minutes ago or so. And, kind of the sentiment is some folks are buying, right? Buying in the 60s. Don't care if it drops more. I won't miss another one on this, right? Sounds a little FOMO-y, to be honest, but hey, whatever works, right? Been scaling out. I feel it needs to take a breath, and that's showing. Will rebuy on larger dips. Might be wrong, but it'd be crazy not to scale out with 250% profits. And, that's a sentiment that happens pretty quick. I mean, if you go back I sold half my position, 74 to 78. Cost basis $7.50 to $8. So not loading up again unless it gets in that $30 to $40 range. Sentiment can change very quickly, especially in regards to these momentum stocks. If I was to post the same thing, I think 2 or 3 weeks ago, the sentiment would have been just kind of like buying, like, Palantir's going to 100. I think that would have been a lot of sentiment. And now you kind of see like, some people actually taking some profits. Like, I'm taking some profits here. I'm not interested in buying here. If it goes down to this number, that number, maybe then I'll be interested in buying. And then, sentiment shifts pretty quickly here. Now, will Palantir and Tesla stock stay down for a while, or will those ones start to come back quite significantly? Well, my opinion is earnings. Earnings are what really is going to matter for those companies. For Tesla, margins, okay? What happens with Tesla's margins? Net margins, gross margins, margins across the board, operating margins for Tesla is going to be very, very important when they report their earnings here in a few weeks. If their margins look very, very good, don't be surprised if Tesla stock catches a bid again. And especially if the margins come in better than where analysts are expecting. Don't be surprised if that was to play out, that all of a sudden Tesla starts catching a bid again, right? Now, in between now and the earnings, you could see weakness in the stock. Same exact thing with Palantir, but not on the margin side. But in terms of could you see weakness continue in Palantir stock till earnings, that's definitely very possible, right? Of course, if the market goes full on risk on in between now and earnings, like all the stocks are going up, right? That's just like, stock market 101. Like if everything's going to fly to the moon because everybody wants to go risk on for the next few weeks, and that's what's going to happen, right? But assuming that the market does not go super risk on, it stays kind of flatline-ish or maybe trends down a little bit, Palantir could have a tough time between now and maybe earnings. But for Palantir, it's not a margin story. For Palantir, it's a revenue growth story. So if Palantir reports much better revenue growth than analysts expect and report a guidance revenue number that's much better than analysts expect, then Palantir will catch momentum again. So let's say Palantir was like 65 going into earnings or something, but then they come in, they smash our revenue expectations and they smash guidance revenue. Then all of a sudden Palantir is going to be back $75, $80, $85, like, boom, boom, boom. But that's a big question. Like Palantir's got to come in and smash revenue expectations quarter after quarter now for a while. They got to play the game of NVIDIA was playing for the last couple of years now. Palantir's got to play that now. If Palantir plays that, stock will catch momentum again. Now, on the flip side, if Palantir reports a very disappointing revenue number, disappointing revenue guide, right? That one will still sell off. Like next thing you know, that stock will be $50, $55 again. It'll happen quick. So do keep that in mind as well, right? These, I could tell you in these momentum stocks, when they have the momentum, like I said at the beginning of this video, they're a freight train. Look out. But as soon as that freight train comes to a stop, it's hard to get it going again, right? Once it gets going again, look out. So that kind of covers Palantir and Tesla there. Let's get into some of these videos and talk some FUBO.
That's right, Scott. I think this is the time of year where we're hearing from investors who are allocated elsewhere and looking at their returns and wondering why they're underperforming the major indices to the degree that they are. A lot of this is just being in the middle of a bull market. Some would say toward the end of the bull market, but suffice it to say, you had 15%-ish average annual returns for the S&P 500. The NASDAQ obviously substantially higher. And you find a lot of people who got back into the market after the great financial crisis or sometime thereafter, but they allocated so heavily to the dividend factor that they really missed out on a lot of what else drives market performance. So I am pro-dividend. 75% of companies in the S&P 500 do pay a dividend. But when you actually analyze it as a standalone factor, 54% of the time, it trails the performance of the S&P 500 over all 12-month rolling periods going back 30 years. So I think when you look at the way companies are now allocating capital, you go back to 1993, on average, companies use 36% of their retained earnings to pay out dividends. That number is pretty constant. What's changed since 1993 is that the cash used for buybacks has gone from 17% to 71% of all corporate cash And that buyback strategy is a thing that companies.
Let me look here. Dividend stocks should be one feature of a diversified portfolio. Dividends are good, but total return is what matters most. 100%. This is very important. If you know my strategy, and I know a lot of you guys love my strategy when it comes to building out a portfolio, right? I see comments very often from you guys. GVD, baby. GVD. If you watch my content religiously over the past few years, you know I preach GVD investing. Growth, value, dividends. In making up a portfolio that is a mixture of those growth stocks, value stocks, and dividend stocks. They're all important. And then you throw a spec stock in there, right? And then if you got big money, you throw a hedge in there as well. That's what it's all about. And the reason that's such an important way of investing is, one, it makes you a well-rounded investor. If all you know how to identify as growth stocks, you're going to run into trouble. If all you know how to identify as dividend stocks, you're going to run into trouble. You got to be a well-rounded investor. Well-rounded investors know how to value growth stocks properly, value stocks, and dividend stocks, and they are not the same. The way you would value a dividend stock or a value stock that grows revenue at 3% a year versus a Palantir, let's say, for instance, that grows revenue 30% a year, very different. Very different. And so sometimes in the market, growth stocks are a rip-off. And so it makes sense to buy value and dividend stocks. Sometimes value and dividend stocks are a rip-off, and it makes sense to buy growth stocks because everybody, usually if you're in, think about it like this. Usually if you're in scary times in the market, where do people want to invest? If they're going to invest into stocks, they're going to invest into the value, the dividend type stocks. They're going to invest in the business models that have been around for 40, 50, 60, 70, 80 years, right? The companies have been paying out dividends for decades and decades and decades. The type of business models that, sure, they don't have a lot of growth, but they're safe. And even in a recession, people still buy those products and services, right? That's where people go. Now, on the flip side, you look at a market really the last couple of years, people don't want value in dividend stocks. They want growth. They want NVIDIA, right? They want Tesla. They want Palantir. Pull up a 2-year chart of Tesla stock. Pull up a 2-year chart of NVIDIA. Pull up a 2-year chart of Palantir, right? Those sorts of stocks. And very quickly, pull up a 2-year chart of Meta. And you'll realize, people want growth stocks. That's the market we're in. That's not always going to be the market we're in. Eventually, things will shift, and then people will be more focused on dividend, value type stocks, right? So, that's something very important to keep in mind there.
17% to 71% of all corporate cash. And that buyback strategy is a thing that companies are doing in response to the fact that it's a better deal for stockholders. You're not being double taxed the way that you are when you're paid in dividends, right? Because a corporation gets taxed, then they pay out a dividend, you, the investor, gets taxed. So I guess it's not really alarm bells. It's more just me saying, look, I understand the psychological importance of getting a dividend. You feel like it's some cash being returned. You love seeing it hit your account. Maybe if you're older, you would rather live on the dividends than have to sell stock every year. I understand it all, but
the other important thing, it's not just about that money hitting your account, right? Like Meta just paid me an $800 dividend recently. Nike paid me out like $500 to the public account recently. It's not just about, that money hits my account. It's about that money hits your account, right? And if you own 5, 10 different dividend stocks, like money's going to always be pretty much flowing in. And then being able to reinvest that out there into that same stock to make your dividends even bigger in the future, or into different stocks you see opportunities. And it really comes in clutch when you go through those markets where stocks are going down, down, down. Because in a down market, you could have stocks be down for 1, 2, 3 years before they come back to old prices, right? Meanwhile, if you own dividend stocks, you're getting paid out all this dividend money. You're reinvesting that in at probably really great prices, right? I mean, imagine you own a ton of dividend stocks going into 2022. 2022 sucked for growth stocks. We all know that. Stocks got wrecked 40, 50, 60, 70, 80% all over the place. Shopify, Meta, Netflix, go through the whole list. They all got wrecked, right? Meanwhile, if you own a ton of dividend stocks, you could be buying the dip on Netflix, on Meta, on Shopify, on all those different stocks that were crashing during that particular time, right? Amazon, NVIDIA, AMD, because you had all that dividend money coming in constantly, right? So dividends are forgotten when the market is great. And that's what the market's been the last 2 years. Look at the performance. S&P 500 was up close to 25% 2 years ago. Last year was up close to 25%. People don't care about dividend stocks in that market, right? But as soon as things shift the other way, as soon as the market starts getting shaky, as soon as it gets harder to make those crazy returns, then people start saying, oh, dang, those dividend stocks look pretty good. And then when you get a recession, then people say, oh, those dividend stocks look great. That's where I want to be positioned in the market. So it could be forgotten, right? And then when you're in those scary markets, growth stocks are then forgotten because people say, oh, look at these stocks are doing so bad. They're down so much, blah, blah, blah. And then when you start to get a little more risk on, then all of a sudden everybody cares about growth stocks again.
The dividend-only strategy, no Berkshire Hathaway, no Amazon, no NVIDIA. Some of these companies...
NVIDIA does technically pay dividend from what I remember. It's very minuscule, but they do technically pay it.
Pay dividends now, didn't for the first 20 years of their existence. And you lose out on thousands of percentage points in some of the most important publicly traded companies today. So it's not anti-dividend.
True.
It's just be aware that there are huge opportunities in the market to not just focus exclusively on that one strategy.
100%. I agree with JB 100% here. Like if you're just on dividends, I mean, you're just going to miss out on so much money. The amount of lifestyle you're going to be able to live and all those sorts of things. If you're just on dividends, no.
You want to engage, Belsky?
I sure do. I love you with all my heart, Josh. I do. But I completely disagree with you because I think that when you take a look at dividends, you can't look at dividend yield. You have to look at dividend growth, which we've shown through the way that we manage money. In fact, Dividend Aristocrats, the DVY, was up 12%. In the U.S., up 15.5%. In Canada, the respective portfolios that we run were up 20% in Canada and 17% in the U.S. Here's why. Because we focus on dividend growth. 60% of the portfolio should always be those core names that have never cut it.
Yeah, but in all due respect, sir, okay, 17% return. S&P 500, if I recall, was up 23% last year. So you got smashed. You know, like I think you just proved JB right. Did you not just prove JB right? In all due respect, sir?
30% should be the names that are growing the dividend, and 10% should be the names that are yields above that. If you're buying companies just because of dividend yield, you can, will, and should underperform. That's what you're looking at in terms of the factor, Josh. I don't disagree in terms of. I don't disagree with respect to the yield part of it and paying the dividends, but we reinvest the dividend. It's a longer-term fact. And, oh, by the way, too, we've had this amazing run in momentum. And as we normalize, again, I've said it before, we're going to be involved in different types of strategies, one of which is going to be dividend growth. Another is going to be value. Another one's going to be small cap. So I think now's not the time to be leaving dividend growth at all.
Josh, I'll give you the last word and we'll move.
I didn't say a word about dividend growth, so I don't have any data on that. I'm talking about the dividend factor, which weights toward high dividend.
Correct.
That's the data that I have.
Companies pay a high dividend for a reason.
We don't disagree.
Companies pay high dividends for a reason, right? Because they're not growing. And, oh, by the way, you don't want to buy those anyway because fundamentally they're not working.
Well, companies pay a high dividend for the most part because their share prices have collapsed.
Correct.
And usually that's indicative of a disruption risk or a fundamental problem at the company. A lot of companies pay high dividends on their way to slashing the dividend entirely in order to survive. Brian, I think the key thing that I want to get across, when I say dividend investing to the exclusion of all other strategies, if you were to weight based on shareholder yield versus dividend alone, meaning dividend plus buyback, your results, this is not my opinion, quantitatively, significantly better.
Correct.
There's this idea that dividends inherently are less volatile stocks. Completely false. The dividend index has a standard deviation of 18.9% versus a standard deviation of 19.2% for buyback stocks, for example. So there are a lot of misnomers about the dividend theme. My point is, it should not be the only reason why you're selecting the equities that you're selecting.
100%.
Yep, good stuff, guys.
Yeah. Okay, that was good stuff. Dan Ives, already, here we go.
Price target's 200. Good morning, Dan. Let's talk robotics and autonomous technology. You say in your talking points or your review of the speech, that alone represents another $1 trillion of incremental market opportunity that NVIDIA can now tap into over the coming years. How do you get to that number, and how do you derive the value you are for NVIDIA from it?
Yeah, I mean, look, to me, I think Jensen laid out the strategic vision for the coming years. When we look at robotics, autonomous, I mean, I believe ultimately those are going to be some of the biggest use cases of AI. And I think what you saw from NVIDIA last night is they're not just sort of going to be a provider. They're going to play a huge role in this sort of vision. And obviously, Tesla on the autonomous side continues to be front and center. I think this is the next step. I think this is a snapshot of the future. And you look at it incrementally. You go out the next few years, I think Street's underestimating growth by 25, 30%, which is why I think not just 4 trillion, you could be looking at 5 trillion market cap.
Underestimating growth by 30%. What is it? Is it robotics? What's being underestimated, so to speak, in terms of the growth for this company?
I think one, it's Blackwell, just overall from a demand perspective. We think 15-to-1 demand to supply in terms of what we see. I think when you look at robotics and autonomous, given the market opportunity, that could ultimately be 15-20% of what I view as disruptive technology. I mean, that could be an incremental 20-25% just to the top line over the next, call it 2-3 years. I think that to me was the sort of watershed moment last night. It's Jensen laying out NVIDIA. It's not just about Blackwell chips, the new oil gold. It's about where this is all going. And we believe autonomous and robotics, that's a huge part of the fourth industrial revolution.
Right. So what does a ChatGPT moment in robotics look like then, Dan? What does that mean?
I think physical AI. I mean, we've talked about from Robotaxi Day in October. I think we're going to be looking next 2-3 years. Robotics is not just going to be from CES, it's going to be real. And I think it's something that's going to play out in factories. It's going to play out in consumers and households. And I think a year from now, we start to go more advanced prototypes to something that's going to become a reality. And I think that's the key here, is that we are still in the early days of the AI revolution. And there's only really one player. I mean, it's NVIDIA's world. Everyone else is paying rent. That was a flex the muscles moment from The Godfather last night.
What about what I was just talking about, Dan, which is higher yields and the fact that all those stocks are down today? I know you're excited about the fundamentals and the innovation here, but does it make you question valuations when we are seeing a rate move like this on some of those ideas?
Yeah. No, look, and that's the push and pull, and I get it. But my view, Sarah, is
NVIDIA, and that stock being down today, it's just a classic. What is this, guys? Like, if you got any experience in the market, you know what this is. Buy the rumor, sell the news. That's all it was. Oh, Jensen's going to be speaking at CES. Everybody buys up the stock, right? Stock moved big into CES. Jensen announces some pretty exciting products, actually, especially some gamers are very excited about some of what NVIDIA showed off yesterday. But at the end of the day, buy the rumor, sell the news. It really didn't matter what Jensen showed off yesterday. It wasn't going to be enough, right? And so sure enough, today, it's after the event, everybody sells off the stock. Like, just typical. That's just how it is.
We have $2 trillion of AI CapEx next 3 years. And even when you look at tech, look at Microsoft just going to 80, from 44, basically doubling their CapEx. You look at numbers, you could say valuation, but I think it goes back to, I think earnings and ultimately top line growth for tech is being massively underestimated into the next year or two. And that's where the growth is. This revolution is not going to be stopped in a 10, 20 bit move on the 10-year.
Alrighty, next one up here. The bull market is still intact, but these factors could hinder it.
We're optimistic about the market still, but you also have to be realistic. We've had 2 really big years of gains, and when you look historically, you look at periods when a bull market reaches its second year. Historically, they last about.
But let me push back against this, because I understand this whole sentiment around we had 2 banger years. True, but remember, 23 was just getting back to what 22 lost. That's all it was. Stock market got hit heavy in 2022. So all 2023 was just a year of getting back to where we used to be. That's all it was. And then 24 was saying, okay, now we can start talking about new highs and new highs and new highs. But all 23 was let's get back to where we used to be. So I do think that's important to remember. It's like if 22 was also a good year for the market, or even a flatline year for the market. Okay. But the fact is 2022 was a down 20% type year for the market in general.
And a lot.
It was down a lot more than that for the NASDAQ.
Be weaker than average. Okay, so you have that. We were talking about on Christmas Eve how the S&P was above its 200-day moving average every day last year. That's only happened a few other times. Average returns were about half. The next year were half the historical average. And then we had over 50 new highs last year, and prior years, 6 other years, 4 years, we were down the next year. So those are just things to be aware of. But overall, the factors of AI, I think what's going on in Washington and the broadening economy are still positive. It's just, I don't think we're going to see another 20% year.
The only thing that it makes me have pause with that, because I understand all the arguments, just where we are at valuations and things along those lines, is that everybody seems to be thinking the same thing right now, that we can't possibly have another year less.
Right. And that's a really good point, because everybody was talking about how the first few days of this year were going to be weak because people were sitting on gains. We're up 1.5%. And so historically, that's been a relatively good omen for the market going forward. But I think you got to have some balance here. And I think when it comes to Washington, it's really interesting when you look at what's going on, because all we hear about is uncertainty this, uncertainty that. How are we going to navigate? Well, there's always uncertainty in the markets. I think we're all aware of that. But I think
you want to know a stock that I'm going to probably buy all of 2025? You want to know a stock that I'm going to probably buy this entire year again? And I was buying it all last year as well? Right there. Cake. I can't get enough of that freaking stock. I just want to unload I want to own the whole freaking company. I want to own the whole company. The whole Cheesecake Factory company. I want to own the whole damn thing, okay?
Last several weeks of the year, people started to underestimate the potential positives of the new administration. And what you saw is when the continuing resolution was passed, and you saw Mike Johnson get reelected as Speaker on the first ballot. The market, 2 of the best days since the election were those 2 days. And I think that's telling us that maybe the market's underestimating what can get done going forward, and as far as the less of the regulatory burden and lower taxes. And I think that could be a positive surprise.
No, this is a problem. This is a problem, what we're looking at here. Okay, I always tell you guys, keep an eye on commodities. I do not like this run we've been on since September, right, in regards to GSG. No bueno. If GSG continues to run heavier and heavier and heavier, then we're going to start talking about inflation being a problem again in the back half of this year. If we start talking about inflation's a problem again in the back half of this year, next thing you know, people are going to start talking about, is the Fed going to have to start raising rates in 2026? We don't want to go through that. We don't want to go through that. No. So keep an eye on this. We need GSG to, on a day like today, with the market being down, with a lot of stocks being down heavy, you would have liked to see GSG move down. The fact that it moved up, everybody should have GSG on their watch list. I always tell you guys this year after year after year. It's something you got to keep an eye on, and it is a significant risk to what it could do to the economy.
Forward in the year ahead here.
Are you still you're still in the double digit at the end of this year? We're up. Or no?
No. I think we'll be up, but I just don't think it's going to be a year like we've seen the last 2. I wouldn't be surprised if we were down 5% or up 5%. Nothing would surprise me these days, but I think the alternatives to the stock market are weaker, I think. So
that's the question.
We're still staying invested, but just reining in our expectations.
But are you fully invested, or would you say you're waiting for something, something to happen, so you try to keep cash on the sideline because you think that there's going to be some moment, or that's not where we are anymore?
No. So what we're doing is we're still invested in our positions. We haven't necessarily been raising a lot of cash, but we're starting to diversify more from the growth orientated sectors of the market to more cyclical and value areas of the market. And so, we're looking
at some examples.
So you look at the industrial sector, it fell 10% in December.
Right.
I think in the industrial sector, you're going to see, if you see less of a regulatory burden, some of these big projects, you see onshoring to the U.S., you're going to see these industrial companies benefit from that. The higher interest rates that we've seen in December were a factor behind that 10% decline. The longer term, we think the industrial sector will do well going forward.
Anything you wouldn't touch right now?
Anything we wouldn't touch.
Right.
I think energy is a tough sector. The economy is doing really well, and oil has rallied a little bit here, but it's still well off its highs. And you look back to the first Trump administration, it was the worst performing sector, even though he was one of the friendliest presidents to the sector, because drill, baby, drill, that's going to mean a lot more oil on the market.
Paul, thank you for coming in this morning. It's great
All right,
to see
thanks
you.
for having
really
me.
Appreciate it. Thank you.
Thanks.
Oil's a huge risk to the market. If that baby goes risk on over spring and summer, no bueno, no bueno. All right, Adam Pitapaka, where's the areas we should
Contributor
invest?
is out with his 25 outlook this year, but of course used to be a semi-analyst in your prior days. Good to see you. Happy New Year.
Happy New Year, Scott. Good to see you.
You have AI-related semis as a key part of your market story for 2025, don't you?
Yes. And I know you always accuse me of being a little bit biased toward the background in semis, but that's true. I like semis over software right now. And I know a lot of clients are out at CES waiting and hanging on every word, just like Christina just said. So it's a big event. I think Jensen will outline a lot of applications and get people excited again, as he usually does when he goes out and talks to the street.
How do I want to think about mega cap tech this year as we get going?
You know, it's 33% of the market, the S&P 500 technology. So even if you're market weight, it's still the biggest position you have in the portfolio. So I think folks have to think about owning big positions in tech. As you see today, a lot of the semi caps and some of the non-NVIDIA semis had really lagged, and so they're catching up. I think there's other names you can own in semis where the risk reward skewed to the positive, particularly because
You know, a big tech stock doesn't look bad to me right now is actually Mr. Softy. Yeah, Microsoft. Stock I've never owned. 16 years in the market, never owned Microsoft. But, you know, Microsoft's been a very weak stock relative to its peers here over the past year plus. And I don't know, man. Like, I have been thinking about this one a little bit in terms of, do I want to do something here? The thing is, there's so many buying opportunities, I feel like, right now in the market that it might not. But Microsoft, I think Microsoft's a pretty good buy right now. Even if you run very conservative numbers of, let's say, 10% revenue growth a year, top line, bottom line, right? And, you know, somebody like Mr. Softy is going to command somewhere between about a 28 and about a 33 P ratio, somewhere around there. So you run some numbers here, and the ROI is not bad. It is not bad at all, just to be quite frank. 33. Wait a minute, or is it bad? Something's wrong here. Net income margins. Is it really only that? No way. So if we ran 10% numbers there, well, let me see where analysts are at. Maybe analysts are way above those numbers for Mr. Softy here. Let's see where analysts are at for next year. 15%, 12%. Really? So let's run projections. You know what? Let's amp it up a little bit. Let's say it's 12%. Okay, let's do 12%, and then, you know, I feel like their bottom line should grow faster than top line. Let's go 14% on the bottom line. Okay, let's amp it up a little bit here. Obviously, Microsoft, law of large numbers catches up, and it's not like this company's going to magically come out with some new product that's just going to change everything for them. Like, it's not super probable, right? And I'm on freaking PayPal. I'm sorry. I was about to say, I'm like, no, I can't change that much. Really? No way. No way. Microsoft's not an opportunity. Really? Because seeing the weakness in Microsoft stock recently, I'm like, I think it's got to be a decent opportunity. But then you run the numbers, and it's like, no, it's nothing. Not much going on there. Wow. So what do you have to get here with Microsoft to get any sort of excitement? What, maybe 15% top line and 15% bottom line? Now, do keep in mind, Microsoft's going to buy back probably a ton of shares over time. That should help their EPS. But still, I'm like, oh, man. No way. Microsoft. Not an opportunity. Not an opportunity.
for a lot of industrials has peaked and is coming down. So I think you want to own the big names, at least in the market.
Now I get why Microsoft's been so weak. Like, you run the numbers and it's like, yeah, it's not there.
And I think you want to own semis where the inventory's peaked.
The market's felt a little wobbly lately. If you look at the price action to end the year and...
Because it's like if you could put money in Microsoft, you put money in Meta, right? You're like, I want a big dog for my portfolio. Meta should be able to grow 15% easy top line and bottom line over the coming years. And if you were to run it at the same valuations for Meta, say a 28 to 33 PE, you just get a much better compound annual growth rate. But Meta should be able to grow that bottom line by closer to 20% a year on average over the coming years, which, then we're talking about compound annual growth rates closer to that 20% type range, right? So, that's a tough thing. You have options in the market. You could look at this, you say, do I want to own Microsoft? Do I want to own Meta? Both great business models, both beast companies. But you run the numbers and it's just like Meta makes a lot more financial sense to be buying, even though that stock has significantly outperformed Microsoft over the past 2 years. Like you pull up Mr. Softy here and you pull up, let's put it against Meta here, right? And then let's go ahead, let's check it over a 1 year basis. So for a 1 year basis, Microsoft's only up 12% versus Meta's up 72%, right? And Microsoft being so weak, that's why I thought Microsoft must be an opportunity, but no, it's not actually. And then we back it up to a 2 year here, back it up to January-ish 2023. And, Meta's up 400+% versus Microsoft's up 76%. You got options in the market, right? And, Microsoft's a really good company. It's just, there's levels.
Beginning the new one, maybe we're trying to right some wrongs here over the course of this week. We'll see what happens. But you suggest more broadly that the equity market is increasingly risky. Those are your words. Why do you think that?
Yeah, and we kind of wrote, we think maybe we're going to be down some in the first half. And, as you and I talk week to week about the upside or the bull case for the market, I sort of felt like when we put, pen to paper, so to speak, in December for this outlook we published today, that a lot of the pillars of the bull case looked less compelling. I mean, margins, I don't think they have quite as much upside. I think there's risk that the CPI could, be troughing or maybe rise in the second half of the year. As we alluded to a couple weeks back when we chatted, I'm not sure people are going to view extra accommodation from the Fed as that bullish. You talked about the 10-year hitting 4.6. So at some point, the interest rate environment's less benign. I'm not sure people are psyched about incremental U.S. spending and that working its way into the big cap tech stocks as much. I don't think people are as psyched about China as maybe they were. So, if you go down some of the bull case, it's less compelling. And I think the last thing is sentiment. A year ago, you could have romanticized on your program your contrarian bull. 2 years ago, you certainly could have, and you can't now. I mean, most of the strategists are out there with 66, 67, 7,000 on the S&P. And so it's not like you can say, I'm the contrarian, bull. So I think it's a little less compelling in the first half of the year when I look at the risk reward.
I can see you on all of that. But what if I say, well, then I'll raise you tax cuts and a friendlier environment for business and deal making and animal spirits and pent up demand and all that stuff that has still a lot of folks thinking that this bull trend is well intact.
Yeah, I think the two most compelling parts of the bull case that resonate with me are definitely the M&A cycle, which I think there'll be a big one. And I think if you do get a 5 or 10% sell-off, that'll probably start more deals. You could see that as the floor in certain industries. And definitely, I think AI productivity, where you're going to get some companies telling you their earnings are improving or they're not going to hire like they would have in the past. Those are definitely bull case things I believe in. In terms of your animal spirits thing, I think there's offsetting points now, meaning out of the gate, we were together on election night. There was definitely a benign interpretation about all the policies. I think now the dollar strengthened a lot. There's some of the policies may not be, quite as bullish for the fundamentals of the company. Some CEOs might be a little bit more cautious about how to optimize their employee mix, U.S. versus non-U.S. So I think you got that initial positive interpretation, and now I'm looking for where will I see a fundamental support, and so I think it's more balanced on that on the kind of animal spirit side. It's really just M&A that I still think will be big.
What if the tariff teeth so to speak, are not as sharp as we once expected that they might be, at least out of the gates.
My view, and this could be wrong, but when I talk to institutional investors, I think people, and that's part of why I said benign interpretation, I don't think people are embedding that in the price of the stocks. I mean, the only policy that I think is in the stocks has been the healthcare price action, where everyone just assumes the incoming, policies from RFK Jr. will impact the earnings of the healthcare companies. That's why they've had the worst kind of 2-year relative performance in 25 years. Interestingly, that's in the price, but not in the price, I think, are, the potential for tariffs to raise prices and companies to maybe lose demand as they raise prices, that kind of stuff. So I don't think, even though that banter is out there and it's been regularly reported on, the stock market guys I talk to aren't saying I'm selling those stocks because of it yet. I think they don't believe it'll be as negative as the banter.
Yeah, a big mistake I think some people are making in this market is they're just like running with assumptions about what the Trump administration's going to do, what's Trump going to do with this and that. Don't put any faith in any of that. Trump says a lot of things. He says a lot of things. A lot of it's just for negotiation leverage. Some of it's for other tactics. But I wouldn't put a lot of faith into Trump said this, so this means this. He says a lot of things, right? He wants Canada to become part of the United States and Greenland and all this stuff. Trump says a lot of things, okay? A lot of it doesn't come true. And a lot of it's not meant to come true. And so, we'll see. We'll see when it actually happens. And then when it actually happens, then you can make adjustments. If you feel like, my company's going to be really hurt by this or whatever, then you can make adjustments. But don't run to all these assumptions about this and that based upon politics. I'm telling you, it's just a lot of baloney, okay? All right, let's talk some FUBO.
What do you kind of think are the implications here?
Well, I think we're starting the year, and it's like Julia just says, sports. So I think that everything about streaming just seems to keep going towards sports. So that's a good thing, ESPN, as she mentioned, and so forth. But I think also, Disney kind of gets a free play here. So they want an independent sports network. Now they essentially have one. They don't have to build it. They just have to invest in it. They own 70% of it. So in some ways, that makes a lot of sense. FUBO, on the other hand, gets to leverage the Hulu brand, which I think they need because it'll make the content they have more attractive to advertisers. And I do think this will increase their advertising revenue. So all the investors that are investing more in FUBO right now, literally right now, I think that's probably warranted.
And this seems, Barton, like it also clears the way for Disney to go ahead with the launch of Venue, right?
Yes, it clears the path for all these different threads that Disney has. Sports is interesting, right? They're pursuing so many different ways to distribute rights. So they've got ESPN Plus today. They've got ESPN on their traditional pay TV ecosystem. And then they're rolling out the ESPN flagship streaming. And now they're also owning the majority, 70%, of FUBO, Hulu, let's call it Hubo, joint venture that will be sports-focused kind of linear service. So they've got every way under the sun to get sports in front of you. And this clears up a lot of the noise and a lot of, the impediments and the blockage that have come from the litigation. They're free to run, and they've got a lot of ways to go at it. So they can have at it now.
So, Mark, a lot of consumers are just kind of their heads are spinning from the options out there right now. How do you expect this to all shake out?
I think it is very. Even understanding the deal is confusing. So I think all these options that consumers do have is confusing. I think ultimately it's what are they interested in? What speaks to them? Do they want to watch football? Do they want to watch college? Whatever it is, and so it's ultimately going to shake out in terms of that. Do you have content that's really compelling to me? I kind of always go back to Netflix. One thing that Netflix is really good at is to basically onboarding you at the beginning of the night and then presenting something to you that you might not have watched. And they're going to do that literally tonight with WWE. So I think Disney still has to figure that out. How do they just onboard consumers and then send them to the right sports content that is compelling to them and they're going to want to watch and pay for or get ads?
No, that's very well said, especially, Barton, when the streaming services, now I'm going to say Hubo every time, Hulu Plus and FUBO combined only have 6 million subscribers.
Only?
Correct. They're one of the options out there. There'll be one of two growth stories in the
That's a ton. Like, people don't realize, they try to compare those against like Netflix or other streaming services that, offer plans that are like $10, $15 a month. You got to understand, like, when we're talking about those TV packages, you got to comp those against like satellite cable type packages, right? Because like I pay like $100 a month for Fubo, $100 a month. So like my value to Fubo is like, at least we can call it 7x or 10x what a value of a Netflix customer would be, right? So that's something I think that's very important in regards to the subject. People are like, oh, it's only a 6 million. I'm like, 6 million people paying $80 or $100 a month? That's a pretty big number there, isn't it? So, Disney Plus is, how much is Disney Plus? Like $8 or something like that? Like, it's just like, I don't think those are the best things to comp against Fubo.
Kind of linear bundle along with YouTube, the bigger kind of traditional pay TV services, are not really growing at this point. They're declining for the most part. And, I think that what we're seeing right here is that this world that we grew up with of turning on TV and getting all the sports on TV is falling apart. The future is going to be the sports you want are going to be tucked away in myriad places, and you're going to have to navigate that. And what's surprising... And
it's very annoying, by the way. It's very annoying for anybody that's a sports fan. You know what I'm talking about. There's a lot of memes out there about this. Like, it's frustrating, right? Like, the unbundling is probably one of the worst things to happen to sports fans, because now it's like, you want to watch this game? Oh, I got to watch it over on Netflix. Oh, I got to watch it on Amazon. Oh, I got to watch it on Fubo. Oh, I got to watch it on this. Oh, and then there'll be random games that, like, let's say ESPN, like, will tuck away, like, certain college football games to, like, ESPN Plus or whatever it is, which is a whole other service I can't even get through Fubo. Like, I would love it if I could just watch every single game just through Fubo. I would even pay more money for Fubo. Like, I'll pay $120 a month, $150. I don't care. I just don't want to have to worry about, like, oh, wait, this game's on Max. Like, literally, you want to watch a certain basketball game, you're going to have to watch it on Max. Certain football games now are on Netflix. Certain football games now are on Amazon, right? Certain football games are on ESPN or this. It's like, holy smokes.
Consumers, the younger set, seems to want that. They seem to want to watch Thursday Night Football on Amazon. They want to watch Christmas football on Netflix, and they'll probably...
We don't want that. No. No one wants that. No, let me be very crystal clear. Not one sports fan wants to say, oh, yeah, let me go try to hunt down this game I want to watch. No one wants that. We would all just love it if there's just one place and we could just click on it and it's like, oh, there's the game. Like the old days, right? When you had satellite, when you had cable. I mean, shoot, maybe we didn't know how good we had it back then, right? Everybody complained about the bundle back then. Oh, satellite cable. We didn't know how good we had it, really. Now you sign up for all these different services, and now you're paying way more money than you would have just paid for satellite or cable back in the day. That's the worst part, for the same stuff.
Carried on Fubo here. So the world's changing, and it's going to be more complicated, and that's just the way it is.
Barton, I love how you're like, I guess they enjoy this. I guess they enjoy this treasure. We always said they enjoy the TJ Maxx treasure hunt. This is like the content treasure hunt, Julia.
But I would say what's interesting is there has been this content treasure hunt, but this is consolidation. This is going to make it easier to find all that sports content in one place. And you could bet once ESPN flagship launches, they're going to make it easy to aggregate all that sports content for real sports fans. So I think as we start the year, this really marks a trend that we're looking for more of, which is a rebundling. I'm not going to just say a consolidation.
And who called out the rebundling? David Gandler. He said many years ago, we're moving to this world of unbundling. And then he said, we're going to move back to a world of bundling. And that's exactly, like, I'm 100% convinced that's what we're going to end up likely seeing over this next 5-10 years. Like, everybody's unbundled. Everybody's realized this sucks as an experience. This is annoying. This is frustrating. And what I think is ultimately going to end up happening, I think David Gandler's right on, and he's seeing the future here. 5-10 years from now, we'll see everybody kind of be bundled together, and you'll be able to access everything in likely one hub again. Like, that's I think there's a very high probability of that because the consumer is getting frustrated.
I think that there are challenges, obviously, when it comes to merging big media companies, that we could certainly see some of that. But a rebundling where we see more of these services packaged together, so it's easier to find your content. So it's easier to subscribe to a bundle that's maybe smaller than the old cable bundle, certainly probably less expensive, but easier to navigate for sure.
100%. You know, and that man right there, he called this out, and that's the world we're going to probably move to, which is honestly probably better than all this crap where you, it's so annoying.
In the company, David, good to see you. So when you
John,
and I last
thank you for
spoke,
having me.
Great to have you back. When we last spoke back in August, you were suing Disney and its partners over venues, saying it was anti-competitive, deprived consumers of choice. Now under this deal, Disney is beefing up Fubo, becoming a majority owner in the company you'll be running. So how does this fix those issues?
Well, I think the combined company, first of all, will have about 6.2 million customers. And as you said, it will be the second largest virtual MVPD in the space. And for me, that's an important moment because it significantly intensifies the competition in the space. And we'll be able to, negotiate deals together, get better pricing, more packaging flexibility, and that ultimately helps consumers. And, as part of our deal, we've amended our carriage agreements, which allow us to launch skinnier bundles to attract customers that are more price sensitive and looking for greater value.
And what will the capital being injected into this venture do for you?
So, as you know, as we've gone from being an upstart, should this deal go through, as part of the signing, we've had a cash injection of about $220 million and a term loan of $145 million. So that gives us significant capital to continue, to march towards our growth plan. And I think together, we'll be able to really focus on three areas. One is sort of the content cost, advertising optimization. There's marketing efficiencies. And we'll look to leverage, Disney's resources and support, to help us grow our business and compete vigorously in space.
David, it's Morgan. It's great to have you on the heels of this news. As we just mentioned, as John just mentioned, your stock finishing up 250%. It just surged. Investors are certainly wrapping their arms around this and seem to be very excited. But I am curious, if we take a step back, how did this deal actually come together?
Good question.
I get this question a lot. Look, as I've always said, our goal has always been to provide value for all of the stakeholders in our industry. And we've said that was for shareholders, for our media partners, and obviously for our customers. And, we initiated, I personally initiated, I thought it was a good idea. I think that, given where Hulu Live is and, what Disney was doing with it, I think it made a lot of sense. And, the key, I think, for the industry right now is to look for ways to continue to monetize programming. And I think this is, again, it's an important deal. It certainly changes the landscape. It's more competitive. And the big winner today, I think, is the consumer.
How does it speak to how quickly the media landscape is changing and evolving here right now, especially as you start to see things like, we're even experiencing it. Comcast, our mother, our parent company with SpinCo. You're seeing it with other deals happening among more traditional media companies as well. But even just tonight, you have Netflix broadcasting its first WWE Raw episode as well. So how does it speak to what we're seeing in terms of cord cutting, in terms of cord nevers, and in terms of this TV 2.0, I'll call it, landscape?
Yeah, look, I think you're right. It's a very complicated space. The dynamics are quickly changing. Everyone's looking to try and reposition themselves for success to be able to attract more customers. We've been very focused on
so that was a good slide there. I wonder how recent this is as of last reported company filings. Okay, so yeah, Spectrum, Xfinity, DirecTV. Think of all of these as like going down. And if you look at the numbers of all these guys, like over the last few years, like they're all trending down, right? And they're going to likely, in my opinion, at least continue to trend down over this next 5-10 years. Like Spectrum, Xfinity, DirecTV, all these are going like that. This guy, And then Dish is with Sling. That's kind of a messy situation. I don't know, what's going to happen there. My guess is those probably trend down as well. So there's two that are going to be going up, in my opinion, in stealing these folks. And there's four that are going to be going down. So my opinion is these four are all going to be going down. This guy's going to be going up. This guy's going to be going up. YouTube TV, long term, probably gets to 15, maybe 20 million subs. Fubo with Hulu Plus Live probably gets to 10 to 15 million, something like that, right? And I'm really just thinking about like 5 years out, right? I'm not thinking about like 10, 20 years from now, because a lot can change in there. And maybe if this Fubo-Hulu relationship goes really well with Disney, maybe they even become the big dog and overtake YouTube TV over time, right? Which wasn't something you could even consider when Fubo was alone. Because it was like, there's no way little Fubo is going to ever take over YouTube TV. But it's like, now with that Disney backing, it's like, you never know. The marketing synergies there could be substantial. When you think about Disney Plus, the ecosystem there, the amount of channels, Disney obviously is going to want Fubo to win because they have 70% ownership of that company. So, when you think about all the broadcasting that ESPN does, all those games that get millions of viewers, my gosh, and Fubo, let's say, has very discounted rates at doing advertising on those games, let's say. There's a lot to be, pretty excited about there, and a lot of synergies. So as long as a deal goes through, it just opens up a crazy opportunity for Fubo over this next 5 to 10 years.
To try and reposition themselves for success, to be able to attract more customers. We've been very focused on super aggregation. It's an area that I've talked about several times now over the last year. We want to be able to provide consumers with different price point video services along the demand curve. And we want to provide them that flexibility. And I think everyone, including Netflix, is looking for ways to ensure that they remain at the top. As it relates to Disney and our relationship, I think that, what we're able to do right now is to offer two very distinct brands. One is Hulu, which will provide a more fulsome entertainment cable replacement service, which obviously has sports, news, and entertainment. And Fubo will continue to double down on its sports offering. And now with these amended carriage agreements, we'll also be able to afford consumers, skinnier sports bundles. So we're very excited about this. I think you'll continue to see significant competition. But what you learned today and what we were able to secure today, I think, is really important as it relates to consumer choice, affordability, and value.
Yeah, obviously I'm very bullish. As long as this deal goes through, I think it's looking really, really freaking good for Fubo. And obviously I shared my in-depth thoughts on the main channel. If you don't watch me on the main channel, it's called Financial Education. You can type that in YouTube and it'll pull it up there. And I spoke extensively about Fubo, my feelings, what I'm planning on doing with the stock, if it goes to $10, $15, $20, those sorts of things. I spoke about all that very extensively last night in that particular video, but obviously very exciting days to be Fubo shareholder. Appreciate everybody joining me as always. If you're looking to apply, join my private stock group, private wealth group, get access to 1000xstocks.com, become a much better investor than what you are today. Click the pinned comment down there, fill out a form. We'll see if we can get you access to all that. Maybe the end of this week or maybe next weekend or something like that. Okay. All right, guys, much love and have a great day.